Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm joined by David Mays, who's Professor of Banking and Financial Institutions at the Auckland University Business School and also a member of the advisory panel to the Swiss-based International Association of Deposit Insurers. Thanks for making some time for us, David. We're obviously here to talk with David about deposit insurance and also the Reserve Bank's open bank resolution policy. Now, David, New Zealand is the only OECD country without explicit deposit insurance at the moment. What is the sort of view of that overseas?
Well, I think most foreign administrations find this very peculiar. They can't understand that we're prepared to expose ordinary people to losses in this sort of way, because in the global financial crisis there have been a lot of losses, and if those had occurred to ordinary people, there would have been real trouble in a lot of countries.
And the Reserve Bank and the government, John Key and Bill English in particular, have spoken out with their reasons why we don't have it. One of the key things the Reserve Bank seems to think is that New Zealand authorities put more focus on this idea of moral hazard than their counterparts overseas do, i.e. that means, I guess, they're worried that it would encourage risky behaviour from banks and depositors if we were to bring it in. What do you make of that view?
Well, I mean, the IARDI, the Association of Deposit Insurers, actually has a paper on how to counteract moral hazard. And it's possible that moral hazard could be important, but the normal argument is if you supervise banks properly, then they don't have the opportunity to run themselves in a very imprudent manner and hence get into the difficulties. So that the sorts of problems you get into are going to be issues of bad luck and bad judgment, which you'd make with or without the deposit insurance.
And the Reserve Bank also talks about the sheer difficulties of defining boundaries and pricing for a scheme. I mean, is that a worthwhile argument to not have a scheme?
Well, everybody else seems to have been able to get around those problems. It is difficult to price the risk of the individual institutions properly. And they tend to do this on the basis of having a number of sort of levels of risk. So they just have a few different levels of premiums, so that some of the small and rather risky banks have to pay more than the large and very stable ones, which pay the lowest rates. But it doesn't seem to be an insuperable difficulty.
And John Key has said that it would just increase costs for bank depositors because the banks would pass on their costs to their depositors. Is that a reason you think is good enough for not having a scheme?
I think it's actually incorrect, because a bank has to persuade people to lend it money. If you're not insured, then you have to offer a higher rate of interest to try and substitute for that. If you are insured, then you're prepared to lend money at a lower rate of interest. So I don't think it's at all obvious that you actually pay more for deposits and increases the cost of capital just because you have deposit insurance. My guess is it actually pays for itself.
And we've also obviously had the recent example of Cyprus, which, I mean, the whole banking system basically failed there. But the Reserve Bank has said, well, hey, they have deposit insurance there and it hasn't really saved them. So I guess their point there is it's not necessarily a panacea.
Oh, no, the position in Cyprus was different. There was an outcry when they said that they were going to haircut the depositors. So although they were nominally insured for €100,000, up to €100,000, they'd in fact have to get back only 93% of that. And that, of course, shocked depositors all the way around the world. And bank shares fell all the way around the world as a result of it. So, I mean, it was quite clearly a negative thing to do.
And in terms of if New Zealand was to introduce a deposit insurance scheme, what threshold do you think we should set in terms of how much an upper limit for how much money of depositors' money should be guaranteed?
Well, I think that's a little difficult. I mean, the easiest thing to do is to say, well, we should do roughly what everybody else does. And the normal limit then in New Zealand dollars would be something of the order of $250,000. What do you have to do to make people leave their money? Most people leave their money in the bank. Well, it's probably quite a lot less than that. Before we had the global financial crisis, then something like $50,000 was the norm, and you could certainly have gone lower than that. So this is an empirical matter where people start getting worried, and what percentage of people you want to cover 100%. If you go up to $250,000, then you're covering 90-something% of people by 100%. If you lowered it to 50,000, well, then we'd probably be in the 80s. But we'd still be most people.
And the Australians, under their system, it's $250,000 is their limit. They also have preference for Australian depositors as opposed to ones from overseas. Is that widespread elsewhere in the world, and is that something perhaps that we could look at in New Zealand if we were to introduce a scheme here?
Well, the depositor preference is certainly a good idea, and indeed depositor preference, if you don't have deposit insurance, I would have thought was essential. Otherwise, our depositors get treated very badly in the insolvency. The advantage of depositor preference, and this is certainly what they have in the United States, is that although the individual depositors don't have preference, if there's a failure, then the deposit insurer has preference when you have the resolution. So it means that the deposit insurer gets paid back first rather than later on. But it's particularly important for the uninsured depositors, because that then pushes them up the hierarchy of claims. So if you've got a lot of people with higher deposits and uninsured deposits, then they'd be keen on this. This is what they did in Iceland. In Iceland, when the banks failed, they felt they could only afford to rescue the domestic depositors. They couldn't rescue the foreign ones, even though they were insured. So they said the only way we can handle this is we'll give you preference in the insolvency. So the likelihood is that all of the depositors will be paid out in full from the insolvency. The difference between the insured and the uninsured is the insured get their money straight away. The uninsured have to wait until the insolvency plays out. I mean, that could be 10 years.
I guess the real benefit of deposit insurance is when only one or two banks get into trouble, because the example of Iceland, for example, if the whole banking system in the country is in serious trouble, then there's probably other things to worry about aside from deposits as well, isn't there?
Oh, indeed. I mean, deposit insurance is designed for individual failures. The expectation is it will normally be small banks and not large banks. So it's just trying to be fair in the insolvency as to who should suffer most. And the idea being that the ordinary person doesn't know much about the quality of their bank. They're the last people who find out that the bank is in trouble. Why should they be in the front line? Deposit insurance says these people don't know enough. They shouldn't be in the front line. They should be protected by the rest of the system.
And what do you make of the open bank resolution policy as a concept, I guess, initially?
Well, as a concept, I think the open bank resolution is an excellent idea, because it's saying in the event of a large bank getting into trouble, we've got to resolve this immediately. So it's got to be done within the space of a day. It's got to be done with certainty as to who is going to bear the losses, and that it needs to be something where you do a lot of preparation beforehand, because to resolve it within a day, you need to be really well prepared. So I think it's the right thing to do. The downside is simply that there isn't deposit insurance. So what the open bank resolution has proposed is saying the depositors will take a haircut. And it might be quite a big haircut under these circumstances, perhaps 20 or 30%. So you're guaranteeing that they'll take a hit. And I think that's the bit which I don't like. Doing it quickly, having the general scheme, an excellent idea. But putting the burden on depositors, no, I think that's a mistake.
I guess another question that some of us have is, if a major bank was to fail, would the government use it anyway? Wouldn't they just bail the bank out?
Well, I think that the idea that one of our large banks was to fail on its own because it had done something which none of the others done really is a very unlikely circumstance. The chances are that we have some generalised problem which is putting the banks into difficulty, perhaps a problem in Australia rather than a problem here, and that therefore you would be into a banking crisis mode, and then what we would end up then is implicit insurance in exactly the way we did this time round in the global financial crisis. You can't afford to let the financial system as a whole collapse, therefore the taxpayer steps in to do something under those circumstances, because that's the sensible way to go. If you've got a crisis, you need to push the problem over a much longer period of time, not concentrate it in the present. What open bank resolution does is say, we're going to resolve it now, and the problems some of the losses will occur later on and people will get paid back. But with a bailout, which is what you get in a crisis, you're saying, well, the taxpayer will front up in the very short run, but it will only get repaid over a much longer period of time, so that you spread the loss.
Well, thanks for that, David. That's David Mays, Professor of Banking and Financial Institutions at Auckland University, and I'm Gareth Vaughan at interest.co.nz.